Welcome to the weekly update, where I'll go over the action in the market for the week of July 7th through the 11th, and we'll see how things look for the week of July 14th through the 18th. Before diving into today's video, if you find it helpful, consider a 30-day free trial to the SPX investing program. This trial lets you explore my unique approach to market analysis. Full-length daily and weekly videos are available on a delayed basis after the market closes. For immediate access, become a member by clicking on the link below. Had a slight down week, down 0.3%, not a real big decline. We're seeing a market that's looking a little exhausted. We continue to be below average with volume. We're getting into the dog days of summer, and things are kind of slowing down. But at the same time, the market's pretty resilient right now. We're in the first half of July, which is the most positive seasonal time of the entire year. But then we hit the second half of July, and then we get into August and September, which aren't as positive. So we want to be aware of that. But for right now, the market is holding up, and we set some recent all-time highs, not only with the S&P, but with the NASDAQ, with the NASDAQ 100, with the NYSE. We still have the mid caps and small caps lagging behind, but even they had a pretty good week until Friday, and then they pretty much gave those gains back. All right, so going through some points for the week, we were down 0.31%. We're below average with volume. We've been below average on the daily side, and that now switches over to the weekly side as well. We're still positive. There's some areas that are giving us a little bit of concern, and that's always the case. But when you look at this on a trending basis and momentum, we're still looking pretty good there. Now, interest rates are starting to go back up. If you remember when we were running into some problems with stocks, not just the tariff when everything was going down in March and April, but when stocks really started to run into some problems, we were going up with interest rates. We want to watch that 4.5% level with the 10-year yield. That seems to be the point where the market says, uh-oh, I'm going to sell instead of buy. So we've been creeping back up that way. Inflation, not a concern as far as the market is telling us, but there are some areas that could be considered to be inflationary. And I'll go through some of that as well. We're seeing the CRB index is in an uptrend. If you want to get more of a day-to-day look at this, please watch the intermarket analysis video. Everything I show for the most part in this video are weekly charts. I go through daily charts in that video. And then, of course, I go through mostly daily charts in the video that I do each day. We did get the meeting minutes from the last Fed meeting, but it didn't really offer much in the way of insight. There's all these geopolitical things going on. Israel, Iran, Russia, Ukraine. Market's not really focused on that very much. We got some trade news and some tariff things that are coming out. That was really what Friday's decline is being attributed to. But even that, the market held up fairly well. Okay, now we're going to start coming into earnings season. Now, there's been a few companies that have already reported. Usually earnings season it's like Memorial Day is the beginning of summer, even though it's really not. Well, as far as earnings, it really starts when the big banks start to report, and they're probably going to report this upcoming week. Okay, as far as our trend, we're still positive there. Didn't show a lot of strength this week like we saw the previous week, but it's still looking positive longer term. Some bullet points here. We had a slight down week with pretty much the entire market. And then there's these tariff letters that are now going out. I don't know if they do it by email or if they write it longhand and all that. Who knows? But it got sent to our trading partners, indicating that they will be facing higher tariffs starting August 1st. So we had the deadline for July 9th. Now it's been pushed back to August 1st if they can't work out better trade terms for the U.S. And that included Japan, South Korea. Those are pretty important trading partners, which face a 25% tariff rate. Then Brazil, my goodness, they received a tariff letter. They probably didn't like getting this one. 50% tariff rate. And then Friday, this is what drove things down on Friday. The futures went negative right after the market closed on Thursday and stayed negative. Pretty much the whole globe had a down day on Friday, but not significant. Canada is setting a 35% tariff rate on imported goods not covered by the USMCA. And then the EU, they'll be getting a letter. We'll sure tell them, yes, we broke away from you 249 years ago, and we're going to tell you what we're going to do now. That's referring to England, of course. And then President Trump declared that most trading partners will see a tariff rate between 15 and 20%, which is higher than the current 10% baseline tariff. Now, a lot of people in the market, they're not really going up and down and bouncing all over the place. They know now Trump is a negotiator. And so he's just throwing that stuff out there, hoping that some kind of a deal will be reached. And that's kind of what the market is treating this as now, not going all crazy over things. There's plenty later to go crazy over. All right, and then the indexes they held up fairly well, given that there was some rather negative news that hit the market, as they perceive this as being used as a negotiating tactic, which I just said, cognizant that there's still time to work out the less onerous terms. Ooh. And then a 50% tariff on copper imports may start August 1st. And there's a threat of a 200% tariff on pharmaceutical imports. Okay, a lot of not real happy news there. The S&P, the NASDAQ, and NASDAQ 100 did set a series of all-time highs throughout the week. NVIDIA got above the 4 trillion mark as far as market cap. They were the first company to ever do that. I remember when Apple, this was 10 years ago, maybe even longer than that, 10 or 12 years ago, when Apple got to 666 billion. Oh, they're the mark of the beast. Ooh. Well, that's like a small company now compared to 4 trillion with NVIDIA. But even though Apple's well over, I don't know where exactly they're at, but they're one of the big boys too. Then mega caps did show resolve. They're still pretty much holding the market together right now, and that helped things overall. Small and mid caps, as I mentioned earlier, they were doing pretty good. It's like, all right, maybe we're seeing some favor here. But we were down on Friday with both of those indexes, and that took away all the gains that we were seeing. And this is what I'm talking about with interest. 4.4, I think I might have said 4.42%. We're at 4.41% there. Depends on how you round the numbers. Where a week ago, after July 3rd, we were at 4.35%. And the dollar, now, this could be an oversold bounce because it's been in a pretty significant downtrend, both on the daily charts and the weekly charts. And so it's bouncing back up a little bit, which could be pressuring stocks. If we do start to see this actually switch into an uptrend, that could put some more pressure on stocks. But so it bounced, but we're still in pretty significant downtrends there. This is the chart that I show every week just to remind us that the way things are right now are not necessarily the way they're always going to be. We're still in this range where inflation, for the most part, has been under control and in most ways going down. But then after that, in the mid to late 70s, we saw this massive increase in inflation. Now, the tariffs that have been announced, it's really not hitting the economic reports yet, but they really haven't had time to do that. So we'll have to see if there's going to be any kind of fallout from those things. Then we're at 4.41%, above the 4.02%. Earnings coming out, we'll get a better view of that over the next week and 2 weeks, especially as most companies in the S&P start to report. But the earnings are still positive. And as I have been saying over and over, they're just not as robust as they were originally forecast. They've been revising those down. So this was updated a week ago. These are long-term unemployed. It won't be updated again until the beginning of August. And then this is also updated at the beginning of the month. Not really seeing any problems here. A few Isabel Net blog charts. The earnings per share with the Magnificent Seven and the broader tech to drive growth over the next 3 years. Okay, yeah, massive. Billions and billions of dollars, I feel like Carl Sagan, being thrown into AI. We just had the release of Grok 4 now coming out. Grok is the AI that I use. And I know there's ChatGPT, and I teach English to Chinese students. They all use DeepSeek. And there's a lot to choose from out there. And Google has their version. Apple, there's, what was it, Claude, I think is one of the other ones. I try to keep up with this stuff, but it's changing so fast, it's really hard to do that. But looking at the Magnificent Seven, how they're driving the earnings per share, communication services, that's another growth area, and tech, taking out the Magnificent Seven. So still the real driving force. That's why we do such analysis on growth versus value. And when growth is outperforming value, that is much more positive for the market. All right, S&P 500 dividend yields, and then comparing it to the 10-year yield. They do have a tendency to go in the same basic direction, but we're seeing a bit of a disconnect here where we've been going up with interest rates and going down with the dividend yield. Okay, what's going to happen? Are interest rates going to come down? Are dividends going to go back up? We'll have to wait and see how that plays out. And then leading indicators suggest upside risks to global manufacturing. All right, here's the global PMI. That's the dark blue line. We're still above 50, so we're showing some expansion there. And then they have this leading here. They jockey this all around, and this actually is looking a little bit better when you break out some of these different areas. Then definitely not cheap relative to bonds, still underneath the zero level here. When we were getting cheaper as stocks were going down, but now that they've been going back up, they're more expensive on a valuation basis. And this is the spread of earnings yield over the 10-year yield. And you can see when we go up above this line, that tends to be better. That means stocks earnings are actually outperforming bonds. And this was a pretty good time from after we finally came out of the, well, here's the .com bust. We came up out of that finally, and then the great financial crisis is in here. And then we've been dropping down lately with the earnings per share ratio here. Then Bitcoin, yeah, okay. People still prefer gold though. A lot of increase coming in here in 2025, and Bitcoin's actually doing quite well. It's in the 110 range or so right now. Gold sets new highs and remains dominant into 2025. And you might believe in Bitcoin and the future of cryptocurrencies and all of that. What's more attractive to a lot of people is gold is tangible. Gold is real, where there's still a lot of hope that's riding behind a lot of the cryptocurrencies. All right, then household net worth as a percent of disposable income, that's been going up. So that's actually a bit of an improvement, a lot more than what we've seen historically going back to the end of World War II. So then FactSet starting to come out with some of their reports here. This is industry analysts project, and I have to move this bar right here that you can't see, 7.5% increase in the S&P 500 over the next 12 months. Okay, so these are the earnings looking right now, and this is what the S&P has been doing itself. And then we've only had 4% of S&P 500 companies report as of Friday the 11th. Of those, I mean, 71%, okay, real small number, but they've reported above estimates, okay? And currently, if you take all of them together, it's 4.6% above estimates. This is almost like a non-event. It's like the beginning of a game or something. You don't judge everything by partway through the first quarter. Mastering the stock market is challenging and can take decades to achieve. Most beginner traders and investors feel overwhelmed and often fail. Stay ahead with the SPX investing program. Members gain access to the full program. Other options include immediate access to videos as they become available. Alternatively, the daily and weekly newsletters may be helpful. Click on the link below to find out what's best for you. Okay, now here is the weekly chart where we actually ended up coming down on Monday, but then we had a nice little bounce going into the close. Talk about a boring day. My goodness, we just kind of went nowhere. This was treadmill land on Tuesday. And then we actually saw a nice little spike up on Wednesday, but that pretty much set the high for the day. And then we came down. And then this was more orderly, though, as we were seeing a gradual increase coming back into the market. We never got back to this high set right after the open, but we did repair a lot of those losses. And then most of the gains that we saw were in Thursday's session, but unfortunately we had the gap lower on Friday. But this could have just tanked down on that news. but the market held up relatively well. It's very choppy, little weakness here, a lot of day trading going on in here. Buying a little bit lower and selling it a little bit higher, selling a little bit higher, buying it back a little bit lower. A lot of that going on. It's kind of a good day trading paradise. But as far as any kind of real trends in Friday's session, you couldn't really latch on to that. They weren't more substantial like we saw both on Wednesday and then ultimately on Thursday. But we gave back a lot of the gains and ended up closing down. So this just looks at the 5 trading days. Now this goes from Monday to Friday. So that way the S&P was actually up almost 0.5% instead of Thursday to Friday, because we were closed for the 4th of July. That's a little bit different way of calculating things. The Dow was down. We had small caps there. If you go from Thursday, the 3rd of July to Friday, the 11th, they were actually still up, even though they were down on the week. So I think I said that wrong. If you go from Monday through Friday, they were up. If you go from Thursday to Friday, they were down. So, but still holding up fairly well here. But small caps are still underwater so far year to date, with the NASDAQ 100 now doing the best, followed by the NYSE. When we were really going down, it was the NYSE that was holding up better. Now that we're going back up, the NYSE is still doing well, but it's starting to underperform some of the big growth areas. Then you have the NASDAQ, and then the pink area here is the S&P 500. Different sectors. I sorted this according to us being up. Usually when we have a down week, I sort it. It would be down here at the bottom. But energy, we're seeing a bit of a bounce back there. Oil is starting to go back up again, even though a week ago OPEC Plus said we're going to pump out more oil in August. That usually pushes oil prices down. And pretty much since they made that announcement, oil has been going back up. Now, some of that could be geopolitical as well. And then utilities, another defensive area. Industrials have been doing pretty good, and that's more economically driven, as are materials. And then the financial sector, we're a little bit concerned there. What I've been doing in the daily video is I show a ratio between the financial sector and the S&P 500. We've been holding up above that 200-day moving average with that ratio. We broke below that on Friday. So that's just something we want to keep an eye on. But we're going to get a lot of earnings coming out from the banks that are part of the financial sector. So we'll see if that has any kind of an impact there. Then, let's see. Yeah. Then looking at the scooter score, we still have the industrials in the high 80s, as is the tech sector. Communication, still not great, but still looking pretty good from a scooter score. The higher, closer to 100, the better it's looking. Where you have staples, a defensive area, and healthcare. 3.3. I don't think this score can go negative, but healthcare is sure giving it a try there. All right, then looking at the different sectors just for the 5 trading days. Energy saw the most gains there. Discretionary has been coming back. And we saw a recent golden cross with the discretionary to staples daily chart. And that's showing some improvement there. And then materials have been holding up. But then the growth areas did okay. Here you had communication down, financials down a little bit. Staples going down, that tends to be more positive. And tech was virtually unchanged for the 5 trading days. Going back to the beginning of the year, industrials, I mean, the real boring things, they've been performing about the best so far. Then utilities, tech, communication, these are the big growth areas as well. Discretionary, even though it had a pretty good week, it's got a lot of making up to do year to date, and healthcare just continues to really struggle. Okay, so this is just the 1 week of the market carpet here. See, Apple was down where Microsoft and then NVIDIA was up. And so that kind of helped things overall here. But look at the financials. A lot of red in this area. Didn't have a good week at all. Discretionary, Amazon was up. Tesla was down a little bit there. Google was up a little bit. Meta was down. So not big gains, but not big losses either. And this helped keep the market together for the week. Now looking at the relative rotation graph, we're seeing tech, XLK, that's coming back on. That's what we want. That's more positive. Where the industrials are actually pulling back a little bit here. They're still positive, but they're rolling over and starting to go down. Then we have areas like communication. That's another growth area, showing some improvement, but still yellow. Seeing some weakness in the financials. We want to keep an eye on that. Materials starting to look a little more negative. And then you have discretionary starting to turn blue, starting to go up and to the right. That's good. That's Tesla, that's Amazon, and that would really help the market if this would improve. And then way down here in the lower left-hand corner, you have healthcare. Not looking really good right now. So industrials and tech are more positive, where you have the yellow areas, communication, financials, and utilities. And then you have the areas that are showing some weakness. These tend to be more defense-oriented, and discretionary is showing some improvement here. Then just looking at the indexes, we have the NASDAQ 100, that's growth, it's coming on. But when we look at the ratios between them, it's the NASDAQ 100, it's actually underperforming the NASDAQ. So the NASDAQ's actually doing a little bit better right now on a ratio basis. Then we have the OEX, that's the S&P 100, the biggest stocks that make up the S&P 500. That's improving. And so we're seeing the large caps and the mega caps really coming back and taking more of a leadership role. We are seeing some improvement with the small caps and mid caps. And actually, we're seeing a little bit of improvement here with the transports, where the more defensive areas like the Dow Jones Composite, that's the Dow, the trannies, and the utilities together, turning up a little bit here, but showing some weakness. And then the utilities, they were looking pretty strong. Now they've been really starting to show some weakness coming in here. Okay, so we have bigger areas, the S&P 100, the NASDAQ 100. Those are green right now. The S&P itself's holding up okay, but it's a balance between growth and value, where you have the S&P 100 and NASDAQ 100 are typically more growth-oriented. The Dow Jones Composite Average, which also includes the utilities, they've been under a bit of pressure. Some improvement with the mid-caps, small caps, and the transports. All right, then looking at sentiment, not really seeing anything extreme here from the investors' intelligence. We are above the midpoint at 2, but we're not getting an extreme positive reading currently. And looking at a composite here, this is the individual investors combined with the sentiment that they put together, coming in, finally getting back above the 0 level here, but not looking extreme. Where we're starting to look extreme is on the daily charts that I show here. This is also sentiment and positioning and broadly recovered since Liberation Day and are more bullish. We are seeing an improvement in the longer term look at sentiment. This is where we're a bit concerned. When I did this video a week ago, we were at 78. We've actually come down, but we're still extreme here. And then looking at the chart, you can see this is higher than we've been in the length of this chart anyway. I think it goes back not very long. But this is a concern that the market is getting taken for granted, that people just think it's automatically going to go up. And so we want to be really careful about that. We want to respect the fact that at some point people are going to come in and want to take some profits and do some selling. So the active asset managers, which were extreme a week ago, they backed off that in the latest reading. And then we have professional managers. This is another look at the active asset managers here. They tend to buy the tops. And as I point out, when I see charts like this, they're human beings. They have peer pressure. They have client pressure. They have their own pressure that they put on themselves. They don't want to get left behind. They have FOMO, just like everybody else, the fear of missing out. And so if they see the market really going up and they're not in, they're going to jump in. And sometimes that ends up being at or near a top. Then looking at the VIX, we're still down under 20. Not a big change on the weekly chart here, but this has been helping stocks as we're under that 20 level. We're still going down with this ratio. That means tech is outperforming cash, and that's positive. And still getting very bullish readings here with the RIDEX bear bull ratio. And we actually crossed a little bit further above 0 here, coming in at 5.8 right now with the individual investor survey that comes out weekly. We're still dropping below the moving average with the Ulcer weekly chart, and we're below the moving average on the daily chart as well. Not seeing any problems here. The spread between risky bonds like junk bonds and government bonds, the risk continues to go down, where here I have an inverted version. Now, it did come up a little bit here, but we're still not really getting high readings overall. And then the VIX and the 3-month average of the VIX on a ratio basis, this is continuing to go down, which in this context is positive. And we're still declining with the long-term equity put-call ratio. That's positive as well. Not much of a change here with the weekly economic index. And we're still below the black line with the Chicago National Financial Conditions. That's positive. Coming in with the latest reading from GDP now at about 2.5%. So that's positive. That's the real takeaway from that. And so here we have the negative GDP quarter, but for right now, they're still projecting that we will have a positive quarter for the second quarter. We have to be in a have negative GDP for 2 consecutive quarters, usually, to be considered to be in a recession. All right, and then here you have the New York Fed staff nowcast. They're actually coming in down a little bit. They're not as rosy as they were before, but it's still positive. That's the real takeaway from this one. And then this was updated a week ago with the real-time SOM rule recession indicator. It has been coming down. It did get up to the red line, and that's where we think, uh-oh, we're going into a recession. But this didn't keep going up. It actually started to decline. And still below the black line with the smooth U.S. recession probabilities, and still coming down with, this is a quarterly report here, the Bray Butters Kelly leading index. This coming down means less likely of a recession. Then looking at inflation, here's the inflation nowcasting. We're just starting the new quarter, so we only have a couple of weeks here of data. We're going to get CPI and PPI this upcoming week, so that'll be the big inflation report. And then it's pretty much a done deal. Now, I know some of the Federal Open Mouth Committee people came out and said, oh, I'd be open to a rate cut at the July meeting. That's not what the market's thinking. Okay, 94.8% chance that rates are going to be right where they're at right now. And the meeting is on July 30th. And the market really hasn't changed that overall stance. Then we look out to the September 17th meeting. There is leaning a little bit more that we'll have a rate cut there. And the data that's been coming out from the Fed suggests that between now and the end of the year, there's likely 2 rate cuts, and they're probably going to be 0.25% each. And the market's still figuring that into the overall mix. And then the market's pretty much still convinced that we're going to be 25 basis points lower after the September meeting. The Fed balance sheet continues to go down as planned, but we're still going up on a year-over-year basis here. And not really seeing anything all that concerning. We spiked up a little bit here with the overnight reverse repurchase agreements, but now it has come back down. Breadth is still looking positive here. Based on price and volume, still above the moving averages. That's looking pretty healthy. Still going up with the 4-week moving average of the new highs, new lows, and still kind of going up, but leveling off now with the 10-week moving average. Declining here, but still above zero with the advanced decline ratio, both short and intermediate term on the weekly chart. The trend is still positive. The green line is above the red line. Even though this is a weakening trend, we're still going down below the moving average. We're still looking positive here with the Arun. We're above zero with the oscillator and going up. That means there's more buyers than sellers. And this is one that I pointed out a week ago. We'll see if this plays out. It hasn't really so far yet. The mass index is telling us that it's expecting a reversal. Well, the things that made this trigger happen was that the market was going up. Are we going to see any more of a substantial decline here? Then here's the daily chart. I still have the dashed line in there. This is the previous all-time high set back in February. We're still looking pretty good here as far as the chart pattern itself, and we consistently are below average with volume. We're still above the 50-week moving average and setting recent all-time highs here with the S&P. Longer term with the trend, we still see the blue line above the red line. That's longer term positive. We've also turned positive on the daily side. And we were down 0.31%, not really much to see right here. Still looking pretty constructive from a chart pattern with, for the most part, a series of higher highs and higher lows as we've been coming up out of those April lows. And we're not quite up to the upper end of this trend channel going back to 2009. Now, again, I put this on here, okay, and I try to stick to technical analysis rules. I wanted to connect these two highs here and then back in 2010 and 2011. And I wanted it to line up with this high that we set back in early 2018. So we got a little bit above that earlier on. We got above that back in 2021. Well, we kind of came right up to that, and then we saw the big decline down earlier in 2025. We still have a little ways to go to get back up to the trend line here. Still looking positive overall with accumulation distribution. We're above the advancing moving average. Now, we did come down with the boom indicator, but we're still above the moving average. And we're dropping a little bit below the midpoint with the McClellan oscillator. We also switched to negative on the daily side as well. but we're still looking pretty good with the summation index based on price and volume giving quite positive readings, and these are longer term than the McClellan oscillator. We're a little bit concerned about the bullish percent index. It declined. It's actually turning negative after giving us an extreme positive reading on the daily side. It's coming down well off of its highs here on the weekly side. It was still looking okay with the Chaikin money flow. This is another smart money indicator. We saw enough of an upward move with the histogram to keep the red line going up, and we're still going up with the Chaikin oscillator. And now we're getting up to this initial extreme area with the vortex, with the green line, but this is still positive. So we just pay more attention to this chart when we go above this line. We really pay attention to this if we go above the red line. And we did see a decline here with the swing trading oscillator based on price and volume, but both are still above zero. Momentum has shifted over to positive after being negative there for quite a while, for pretty much all of 2025 here. We finally are bouncing back and looking better. We did advance based on price and volume, although we did decline, but we're still above 50 with the PMOs that are rising. The buy signals are declining, but still above 50, and we're flat, but still giving a high reading with the PMOs that are above zero. And the Bollinger Bands here, we didn't go outside of the upper Bollinger Bands, and we are above the midpoint. That is more positive, even though we had a slight down week. So momentum has really shifted back over to positive with the short-term, intermediate term, and even the longer-term oscillators. And the Copic curve is also positive. That's another momentum oscillator. We declined, but we're still positive with the force index, and we're still getting a pretty high reading here with the money flow. And we're above 50 with the RSI 14-week. The Stochk RSI showing good longer-term momentum. Now, we're actually dropping on the daily side. We fell down here, but we're still above the midpoint. This is longer term, and this is just showing that the momentum is still longer-term positive. Williams percent R still extreme on the daily side. It's also extreme here on the weekly side, which shows longer-term momentum. And starting to go extreme again with the ultimate oscillator. Had a slight down week on a week-over-week change, but we're still looking pretty positive. Coming up to this initial red line here with the rate of change going back 50 weeks. And we're still positive with the Special K weekly chart. We continue to be negative with the Special K daily chart. And then I'll redraw these if we really start to go down, because now this Fibonacci, all these levels, they need to be wherever the high is. That's where you calculate it to. But, you know, down 0.31%. I don't think I want to come in here and change the retracement levels right now. It's not like I'm trying to pick a top here. Okay, still looking good on a trending basis with the Heikin Ashi. The Kagi is black and pointing up, which is positive. The Renko chart is positive, and the three-line break chart is also positive. Didn't see enough of a move to draw in any X's or O's. The last that we saw was positive with X's here with a double top breakout that was generated back on June 2nd. And we finally turned positive here. We've been just dancing along just a little bit above zero here on the daily side. We actually went positive with the ease of movement. That's a pretty big change. It had been improving since the April lows, and finally, this week, we finally started to go positive here. And we're still looking okay with the long-term momentum, intermediate-term momentum, seeing a little bit of weakness now, but still positive with the short-term momentum. And we're still positive with the Elder's Impulse system with green bars, and we're positive with the parabolic SAR. We're positive on the daily side as well. And for some reason, they still have the small caps negative. It should be with the IWM. We're above the 200-day moving average, and that's when this should be green here. But for the most part, we're still looking positive with this. Bonds are now negative across the board based on price, as is the dollar, where commodities are positive across the board. And here's this chart that I seem to always want to show you twice. Okay, so we did set some new highs here with the S&P. Still have a ways to go with the mid caps and the small caps. The Dow not quite in an uptrend. It's not on a daily trend. Excuse me. It's not seeing a golden cross on the daily side either. We're close, and there's even been some folks that think, okay, if we stay above here, it'll be on the 17th. That's when it's going to give us a golden cross. Well, okay, we'll see if that ends up happening. We're probably going to, because we would have to really fall for this to go down below the moving averages. But we are improving with the Dow. We are in a longer-term uptrend with the NASDAQ as well as the NASDAQ 100. The mid caps still in a downtrend, but finally getting above their moving averages, and the small caps. Now this is the S&P 600. This is not the IWM, which is another popular small cap index. But we were improving here, but they ended up being down on the week. The NYSE just coming off of setting recent all-time highs and in an uptrend. This is a daily chart of the Wilshire, which is in an uptrend. All stocks still looking pretty solid there. FANG index just coming off of recent all-time highs. ARC is in an uptrend, both on the daily side and here on the weekly side. The banks, just want to keep an eye on this. They're still looking okay with the KBW Bank Index. Just coming down a little bit with an extreme reading with the RSI, but the momentum continues to be positive. Seasonality, and again, I should have switched this over here. For going back to 2021, we have 100% positive July with a 3.3% return. Okay, so this is looking at just the Dow, the trannies, and the utilities. Not quite back to a high yet with the Dow. We are seeing some improvement with the transports. And the utilities are kind of drifting higher longer term here. With each video and course, members learn to implement the consensus approach, a unique analytical method. Unlike relying on a few indicators that eventually fail, this approach overcomes analysis paralysis by using the weight of the evidence to draw conclusions. Developed over decades across all market conditions, explore the SPX investing program and start with a 30-day free trial. Then this is where we're seeing more of an uptrend here. Commodities on the daily side and here on the weekly side are in an uptrend. Oil did go back up. It's into the high 60s now. This is encouraging economically. Copper just really broke out, both on the daily side and on the weekly side here. We're in a pretty solid uptrend here, and that's a good barometer for the economy. The dollar, even though it's bouncing back up, is still in a downtrend. Gold just kind of chopping along sideways right now, but silver broke out, so that's actually looking quite a bit better there. We're still positive with bonds based on price, and we're still positive with the longer-term stock-to-bond monthly ratio chart. And this shows how interest rates are coming down, but now we're starting to go back up, and that's giving a little bit of a concern to us. And we did go up over the week with international. This is a weekly chart of US, UK, Japanese, and German rates. We see them going up more hand in hand. We still have gold, the best performing asset in 2025. Stocks are in second place. Commodities, the purple line, they're in third place. Oil is now jumped back up. See how just it goes positive, then it goes negative, then it goes positive. It's going all crazy here, where the dollar is still the worst performing asset. And then the weekly chart of the NASDAQ 100 to S&P 500, this is still holding up. Growth is outperforming growth and value. The S&P 100 is outperforming the S&P 500. Growth here is also outperforming value. And we're pulling back here with gold to S&P. As the S&P has been going up, but gold has pretty much been going sideways. That makes the ratio go down. And this keeps going up, not because we're seeing any real strength in gold right now. We're seeing a lot of weakness in the dollar. Bonds continue to underperform stocks longer term. Low volatility stocks, when this ratio is going down and we're starting to see a death cross here, that is more positive. Discretionary improving when compared to staples. We want this to continue to go up if we're more positive on things. And even though energy had a pretty good week, it's still underperforming tech pretty severely longer term. And then small caps underperforming tech as well. And we've seen that now. Going back to what, 2015 is when this downtrend started. Okay, then longer term, not really seeing anything all that new here with the NYSE breadth thrust. We did get an extreme reading here with the swag NYSE breadth thrust. Not that this is a signal, because we have to get a real low signal and then thrust up to a higher signal quickly. Well, we just had an extreme reading here, and that could be a little bit of a concern. Longer term, though, we're still looking good here with the weekly chart going back to the 1987 crash. Still well above the longer term trend line with that same trend. Still right at zero with the Zohar-Chak method. And still looking good here with the 50-period moving average of the S&P highs and lows. That's continuing to go up. And we're back above zero and climbing with the NYSE new highs, new lows, 50-period moving average. I've been pointing this out in the daily videos. Again, this is a trend line that I drew, so it's probably not scientific or anything. I just tried to go from this low and then match up these lows back in 2016 and then just run the line forward here. This could be providing some longer term overhead resistance, even though there have been times when we broke above this trend line. But this is looking good here. The NASDAQ growth to Dow value ratio still above the red line. The Qs to small caps still looking pretty solid there. 3-month yield for the most part is going sideways, and we're still trying to go up here with the cumulative new highs, new lows for the NASDAQ. Seasonality. Okay, we're just finishing up the first half of July. That'll switch over to the second half, which is still positive, but it really underperforms the first half of July. And then we're in here with looking at July, we're up 53% of the time going back to 1964 with a return of 0.8%. Then June through November is not a great time, but we are positive with a 3.4% return, up 67.6% of the time. And post-election years have really been performing well, and that's what we're in right now. Where a lot of people think that it's election years that do, oh, it can't go down, it's an election year. Well, you can see here it's not the best performing, at least in recent history here. And then this is where we see a little bit of a dip from June into July before we see some strength, at least here, going into August. Then for the S&P 500, going back to 1950 for post-election years, we're up 12 out of 18 times, down 6 out of 18 times with a return of 2.2%. No matter how you work the numbers here, post-election years are positive for July, going back to 1950. Then this, I showed this a week ago as well. This is the 4-year composite presidential, where we do see a little bit of weakness here before we see some more strength coming back. And then this is lackluster June, usually means we see a pretty good July, which we've been seeing a fairly good one so far here. And then volume really drops off, both for the NYSE as well as the NASDAQ. Not a real surprise there. Thank you. I hope you're having a wonderful weekend, and I will talk to you in the next video.